Hi. Two of today's key business challenges are higher input costs and higher interest rates. On July 24th, the Bank of Canada announced a second successive quarter point interest rate cut. Suddenly, we are in rate cutting mode, and the bank promised there's more to come. What does this mean? Is the inflation battle over? Will lower financing costs make things easier? Or is the economy tanking? And what about the world outlook? Are things going soft there too? What messages are there for Canadian exporters? To answer these questions, we are again joined by Peter Hall, who will give his take on the recent comments by the Bank of Canada. Peter, welcome again, and over to you.
Well, thanks once again, Caroline, for your kind words and warm summer wishes to the FIT community. Easing into the fall season isn't our normal modus, but it's clearly on the Bank of Canada's menu. Their July 24th rate cut was the second in a row. That's big news. It says a lot about the status of the inflation battle and about the broader economy. We are clearly in an easing cycle, and there are more rate cuts to come. Well, how can we be so sure? In its communications, the Bank of Canada was clear that this was not the end of the cuts. Having said that, they did not map out what that would look like in terms of the speed and depth of the cuts. The governor is clear that while the Governing Council consensus is for lower future rates, they are not on a predetermined path, and they're going to take it one meeting at a time. Well, in addition, the outlook in the accompanying monetary policy report hinges on brightening prospects for Canadian consumers, whose spending is going to be boosted in the future by lower interest rates. The governor also mentioned in response to media questions that this, or the rate cuts to date, isn't a huge change, as much as saying that cuts to date aren't enough to get the consumption boost embedded in their own forecast. Ergo, more and larger cuts coming. Now, for the internal Canadian economy, the story has taken a grim turn. We have 3% population growth, but we are only able to generate 1.5% GDP growth. Inflation numbers are coming down, and now there's a risk of overshooting. If monthly price growth averages 2% in just the next 2 months, Canada's year-to-year consumer price index will drop sharply from 2.7% to just 2%. And core CPI from 2.9% to 2.4%. That doesn't sound alarming, but take away mortgage interest costs, the inflation that was actually caused by higher interest rate policy, and suddenly prices for all other things are collectively in the disinflation zone. In the Bank of Canada's own words, inflation is no longer broad-based. This all speaks to a weak underlying economy. We all have to live in this economy, so the shift in the Bank of Canada's overall messaging is sobering. But is the news all bad for exporters? Not exactly. Like the tightening cycle, Canada is out in front of rate decisions by the U.S. Federal Reserve Board. However, unlike last time, the Fed is in no rush to join Canada's easing stance. Stronger fundamentals have made it more challenging for the Fed to dampen price growth. U.S. consumer prices are currently rising at a year-over-year rate of 3%, and they are sticky. Core CPI is at 3.3% and even stickier in spite of higher U.S. interest rates. With the Canada-U.S. short-term interest rate gap widening, the Canadian dollar is taking a hit. In just under 2 weeks, the Canadian dollar has shed a full U.S. cent and is down by over 3 U.S. cents since the end of last year. A weaker currency should boost the short-term export outlook. Now, there's some worry that cracks are developing in the U.S. economy itself. Indeed, growth has slowed from the robust pace seen toward the end of last year. Interest rates are likely having an impact, and public spending has recently been more of a drag on growth. However, U.S. personal debt dynamics are very different from ours. While we are managing a staggering 180 to 185% debt-to-income ratio, the U.S. equivalent is in the 100% zone. Consumers are less upbeat than usual, not a surprise given higher interest rates, but at the same time, employment gains have been decent, and the unemployment rate stateside is still not far from historical lows. The U.S. housing market is also much more balanced than in Canada. In fact, a long stretch of underbuilding suggests years of future pent-up demand. Business investment is also in catch-up mode and is being boosted by the nearshoring trend. All things considered, U.S. demand seems in better shape than ours, reassuring news for Canadian exporters. And of course, the second quarter GDP numbers were quite bright at 2.8% growth on an annualized basis. That speaks to a U.S. economy that is surprising on the upside with its fundamental strength. Now, a further piece of good news is that the domestic price growth here in Canada will ease. For all intents and purposes, the Bank of Canada has all but won the inflation battle, and we can look forward to stable prices at the 2% level for some time to come. Sure, there are risks to that outlook, but our general price expectations are also coming back down to the 2% level, and this in large part determines contract setting and is instrumental in sustaining the Bank of Canada's target price growth. Even so, prices will generally remain about 9% higher than if the inflation run-up hadn't occurred in the first place. Now lastly, perhaps the most obvious piece of good news is that borrowing costs are coming down. I expect there will be 1 or 2 more cuts before year-end, and depending on the Fed's appetite for cuts, Canada could see 5 more 25 basis point cuts in 2025. If that doesn't prove to be enough, interest rate cuts could actually even extend into 2026. When the economy stabilizes, it is likely that the policy rate will return to roughly 3%, a reasonable neutral rate, in my humble opinion. In sum, there are a lot of messages that accompany the Bank of Canada's recent rate decision. This is now an easing cycle. More rate cuts are coming. The Fed is not moving rates for now. The Canadian economy is weakening. Prices are stabilizing. The Canadian dollar is weakening. Business borrowing costs are coming down. And the export outlook is brightening. I hope that in this messaging you can look beyond the darkening domestic scene to an export picture that could well prove to be Canada's brightest near-term growth prospect. Enjoy the rest of your summer. I'll see you next time.